I am deciding between a joint venture or a syndication for a 120 unit apartment I'm working on outside of Baltimore. Here's a couple questions I have. What is the difference between a JV, a syndication, and a fund like yours?
So joint venture, actually, we teach that in the training that we have for syndication. I go through an entire session where I talk about buying it by yourself, doing a joint venture, doing a partnerships, doing a syndication. Okay. So a joint venture is you and somebody else. You're going to joint venture. So now let's say you joint venture with me, just as an example. Now I have opinions. I want to tell you, no, Reese, I don't like that we're going to paint the building this color. I wanted this. No, I don't like to evict these people. Let's just evict a few so it doesn't cost us so much. It's like, whoa, so many things to make a decision on that. A syndication would be, let's say you set up your own syndication and somebody just invests with you. And the syndication will have a private placement memorandum that's going to say, we're going to take your money. We're going to invest it in this type of building. This is what we're going to pay you. This is what we're going to do with the money. And this is how long it's going to take. So now they give you the money, you make all the decisions, and God bless you, you gave them a free ride. And I mean, in terms of like decision making and hassles, they have really no liability. They have some potential loss, they're taking some risk, but there's no liability. If you get sued or the property gets sued, they don't get sued. They're just unit holders. So they get a certain return. Now, if you offer them even an equity syndication, like they get so much cash flow and then so much when you sell it from the upside gain, that's still a good deal because you're by yourself making the decision. Nobody has to dispute every step you're making. And especially when you're buying a 120 unit apartment building, most likely they are going to want to be, if there is syndication, they're going to want to make some part of the upside gain. So the difference really on 120 units is, do you want people to make decisions with you? Do a joint venture. So every time you got to make a decision, you're going to have a committee. You're going to have votes. You're going to have people approving things because it's a joint venture. A syndication is people giving you the money and you make the decisions for the group with the expectation of profits for them. And you're going to tell them this is what I'll pay. You ask me from experience, a syndication is better for this type of business. Now, what's the difference between what I have, like my fund? My fund is a debt fund. People give me the money and I put it not in one building, but in many different types of properties. I have the commercial mixed use in Puerto Rico. I have the luxury end in California. So I make all the decisions. I pay them a fixed return. They're happy. If it took me longer and it cost me money and I lost on one deal, I still made money on 4 or 5 other deals, way more than making up for this one. They're getting their steady returns. They're happy. I'm happy, and I'm able to diversify the money, giving them lower risk.
Which type of fund is easier to manage, a Reg D 506B or a Reg D 506C?
Okay, they're both equally the same when it comes to managing because you have to report numbers, you have to pay the payments as required and all this. But the SEC prefers the Reg D 506C because you're doing public solicitation, but you will only accept accredited investors. And if you do it right the way we teach you, you will actually get these accredited investors accredited per a third-party company that will verify with them and tell you, yes, we give you the blessing, they are accredited. So that's very important, very powerful. So a bit easier in terms of SEC regulations, but it's, I mean, I can tell you, I prefer when you start with a B, Reg D 506B, because it's friends and family and no third party has to qualify them. And you can take up to 35 non-accredited people. So talk to friends and family, get to know them, they get to know you, and we show you the process, and then you can raise capital and start small. Again, start small, raise 1 million, get into a small deal, do it well, and now these people that you have will refer more people to you. You'll be amazed. We grew organically to 20 million, like from 5 million to 20, organically, people referring people. Yeah, a few people along the way went out. I'm curious to know what they did on their own. I have a guy went out, lost money, came back in. I have a guy went out, went in the stock market. Now he's telling me he's losing money. Heck, we had a guy saying, I am going to invest with you. Ashley's my witness, right? I'm investing with you, but I want to wait a couple more days in the stock market because I think it's going to go big now. Yesterday, what did we get, Ashley? An email, the guy says, sorry, I lost 50,000. I need to wait till the market comes back. or steady return secured against real estate. I mean, there's a big difference there. But the key thing is, yeah, it's important to manage it right and do a syndication and set it up. The way I set it up, I think, is the cleanest and easiest. Mm-hmm.
Well, and piggybacking off of that, so she and I have been talking about this. Her next question and her last question on this topic is, if I decided to pay investors equity versus debt, how do I work those numbers on the equity piece? I'm raising $10 million.
Okay, so that's good. 10 million is very good, very powerful. Sometimes the bigger buildings are easier to manage because you have enough income to have all the help you need. So how would you pay? The answer to this is the building, not you. Because if you got a building, let's just say, let's fantasize for a moment, you got a building making 10 to 11% cap rate. Cherif, are there such commercial buildings doing that? Yeah, there are so many people don't know what to do with hotels, and you can buy them at 10% cap. I'm talking in decent location, not out in the booties, okay? And if you know what you're doing and reposition them a little bit, they'll make 12% cap. That means 12% return if you paid it cash. Now you get a loan, you could be making 15. But if you don't know anything on hotels, you might as well do something else that you're comfortable with, something smaller or whatever. I'm just giving examples here. So based on how much the building makes, you got to be realistic. Let's say you want to pay them 5% cash flow per year, and then you're going to sell in, let's say, 5 years. But when you sell, it's going to be a huge home run. But it's not going to be realized right away because you're raising a lot of money. Some of the money will be used for rehabilitation work. It's going to take 2 years. And then you're going to get new tenants for the building. And then it's going to take 5 years. But when you exit, it's going to be double the price. And double the price, but you're actually raising only 30% for the down payment. So you're going to make 3 times as much on the investor's money. So then you can offer them very little cash flow and a huge equity part, 70% on the exit. And you will still make millions, and they will make millions, and they will want to continue with you. So the answer to this is the deal. That's why we analyze when we set up somebody for the fund, we have them come and present and work the details of the deal.